strip malls as well, if you look at like path of growth and where people are moving to, you have some pretty great locations that have necessary businesses that people drive by and stop at frequently. And they're good sources of investment opportunity for longer term cash flow. They don't look as sexy. They don't sound like, ooh, that's a cool development project you built up. It's like, no, we didn't build anything. We just bought an existing strip center that lots of people go to, as has a Panera in it, or it has a vitamin shop in it, or something that people are using, and it's steady performer. So, but that doesn't sound super exciting to a lot of people sometimes, because it doesn't have that like allure of something that's like big and crazy and cool.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is David Codrea. Dave is the co-founder and partner at Greenleaf Capital Partners, leading the integration and growth of its investment and operational aspects. Greenleaf is a full-service real estate firm, is dedicated to long-term cash flow-driven investing. And in just a minute, we're going to speak with David Codrea about the hidden opportunity of small strip malls near new construction developments. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, David Codrea. Welcome to CREPN Radio.
Great. Thanks to be here. Excited. How are you doing today?
I'm good. I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, so I'm I would say a real estate junkie. I've been doing it my whole career, and it's what I wake up and love to look at every day and drive around, try and find opportunities. Based out of Atlanta, and really have invested in, I like to say, everything other than hotels and self-storage. So done mobile home parks, warehouse, retail, medical, apartments. I kind of run the gamut of different opportunities out there.
Got it. Now, before we started talking, you mentioned you're in Atlanta, is that right?
Correct. Yeah. So based out of the Southeast, and that's primarily, I mean, it was a population move. As I like to tell my wife, I was like, look, there's people moving to the Southeast, so we were going to follow suit. So I moved to Atlanta, and that was back in like 2008, 9, started buying deals in the Atlanta area, and then kind of just expanded the footprint a little bit, but all in the Southeast.
Got it. And the asset class that you primarily invest in, is there a primary or do you have?
No, I would say every 24 months, 18 to 24 months, it kind of shifts depending on where the market's at and where the opportunities are that exist. And it's kind of whatever seems like it's out of flavor, or, people are kind of down on, that's when I get interested in it and look to go in. So right now, retail for the past couple of years has been exciting. People have talked about how retail is going to die, and it hasn't died. And then a little bit of office too. Office is looking pretty interesting right now. Those two are the things
Yeah.
I'm buying right now, but started buying apartments, single family homes, student housing type stuff. Um, so I've done a bunch of different asset types.
Got it. Got it. So specifically today, we're looking to talk with you about the retail strip malls, the hidden opportunity in retail strip malls. And I'm curious, how long have you identified retail as a viable opportunity, and specifically
Yeah.
the ones near newer construction?
Well, if thinking about retail definitely faced some huge challenges in 2020. And then in general, the kind of inside out there has been fairly negative towards retail. And but you have all these different things that get lumped into retail, whether that's a quick service restaurant, or is it a gas station, or is it like a legitimate strip mall or big box stores. You kind of throw all that into one pool, and then it's like, sure, I mean, any one of those things could be doing good or bad at any given time. Uh, so I've been doing it for about 6 years. We've been investing in different retail opportunities, and a lot of them have done exceptionally well. Quick service restaurants have performed well over the past years, and now some dine in okay stuff hasn't, right? But strip malls as well. If you look at like path of growth and where people are moving to, um, you have some pretty great locations that have necessary businesses that people drive by and stop at frequently, and they're good sources of investment opportunity for longer term cash flow. They don't look as sexy. They don't sound like, ooh, that's a cool development project you built up. It's like, no, we didn't build anything. We just bought an existing strip center that lots of people go to, as you know, has a Panera in it, or it has a vitamin shop in it, or something that people are using, and it's steady performer. So, but that doesn't sound super exciting to a lot of people sometimes, because it doesn't have that like allure of something that's like big and crazy and cool.
Well, if anything's proven out true in investing in real estate, is boring and predictable is a lot better than, oh my God, up, down, up, down, up, down kind of thing. So I
Yeah.
would be a big fan of boring and predictable. Uh,
Yeah. I'm
uh,
not a big fan of up, down, up, down.
yeah,
I don't,
I like up. I don't like down. So unless I'm the buyer of it down, but I don't like to be the guy that's writing it down. That's not good.
yeah.
So can you describe kind of the range of tenants, and then also kind of let's talk about the size of an ideal opportunity for you on the retail
Yeah.
strip mall stuff.
I mean, the range of tenants is enormous.
Hmm.
There's uh, deals where we have sports training, pharmacies, a lot of like medical that comes into stream, like dentists locations that come in. So there's a plethora of opportunity of these local kind of service oriented businesses that are going to be there. And there's just, I mean, they kind of need to be close to their customers. So you're not going to travel 50 miles to go see a dent in a more denser, urban area. You're not going to be traveling that far. So they're good tenants. And then price
Right.
point, most of these are, call it 4 to 6 units that are there. I'm typically looking to do smaller size suites, like 5,000 square feet or smaller. Um, and then therefore your price point is always, you know, a couple $1 million. We're not talking about 30, $40 million deals, and they're not $300,000 deals. So if you're going to spend a couple $1 million on putting one of these opportunities together.
Got it. And the opportunities that you found that you've done well on with these newer developments, have they typically been full, or have you found that vacancies have been an issue and just need to be
Yeah.
re-tenanted, or can you kind of
Yeah.
describe what the opportunity looks like?
I'm always looking for some kind of value that's out there. So a little bit of vacancy isn't necessarily scary. You can normally bring that up to like more market rent, especially if you're in a good area where, there's construction going on around you, or they're building houses further out, or something like that, where this is a road that everyone's going to be traveling down. But vacancy doesn't scare me. I mean, we buy some stuff that's fully vacant, and those are great. Those are pretty hard to find. So
Yeah.
you're going to get someone even at a low base rent that's in something. So actually vacant place is hard to find.
Right, right. So on the tenant list you kind of mentioned, it's wide open as far as the opportunities. Are there any class of businesses you found that are problematic as far as the tenant mix?
I mean, dry cleaners always cause a little issues as you look at like people get nervous with them or the environmental issues that can be associated with them. So we haven't done any of those uh, tenant locations, but other than that, uh, we really haven't found any that are like, hey, this one is a huge challenge to operate with. A lot of our tenants are smaller operations where you're dealing directly with people that are running, either one location or maybe they have 10 or 15 locations that they're doing. So I feel
Right.
like we get pretty direct, pretty quick answers in a lot of those formats.
So when you're appealing, trying to find a new tenant, um, and on habitational, you're basically looking at their ability to cover the rent, any kind of prior derogatory type stuff. With the business, can you go into a little bit of your criteria, or what are some of the driving factors that you look at when selecting a potential tenant?
Yeah. I mean, you obviously want to be able to see them cover the rent, but that's part of it, right? Like we want to know what their build out looks like. And sometimes some of the build outs are extensive where, if we're buying something that's, $100 a square foot, are they going to put in $150 a square foot to do some crazy build out that can't really be reused? So we had to consider what that build out and what our contribution to that build out has to be. We're the market right now, we are always contributing uh, dollars to the TI build out for a tenant. So that's a big upfront cost that has to go into the underwriting of who's going to move in. So that's really a big part of it. And then two, how quickly can they get their operation up and running and paying rent? Sometimes it's hey, it's going to take 12 months for us to fully deploy our team in there and do this. Not my team, but like the tenants team, if they got to go hire staff or do an extensive build out. So uh, we're looking more for the faster moving rate. That would be ideal. And we're willing to sacrifice a little bit on rent to get that. We're not going to hold out for 12, 18 months just to get that absolute top dollar rent. We think time erodes a lot of value. So I want to see someone that can move pretty quickly. And they'll hopefully, I mean, they'll get a better rate for moving a little bit quicker. Uh, but it works on the investment side to fill up a space.
Got it. And as far as tenant selection, do you lean towards a mom and pop kind of a one-off, or do you try and lean more towards to like a brand name, like you mentioned, Panera or
Yeah.
some sort of a
I,
franchise?
we're open uh, on either one of those. A lot of times, so we are working with brokers on a lot of stuff, and sometimes it's like, hey, we just do all of our. There's two avenues of looking at saying, hey, I just do my own internal leasing because I don't want to have to pay brokers anything, or you use brokers. But a lot of times, brokers are bringing people that are ready to go. So a lot of times, yes, you got to pay. However, it can speed up the process significantly, and that's really an investment that's worth it on the
Right.
speed side. So, but most of the time we're not doing like huge organizations. Most of the time it is smaller tenants. It's typically not a absolute first time location. We have a few of those that come in. We know those will always take longer. Whatever the plan is, it's always going to take a little bit longer to get going because it's the first time they're doing it.
Right. Right. What's your experience been with the length of their stay as a tenant?
We're typically looking to do 3 to 5 year leases. I'm not interested in really like a 10-year lease because that 10 years just seems like it's too far out on the performance horizon to see if this is actually going to work or not.
Hmm.
So typically looking at 3 to 5 years, and we don't have, you know, we've got about a little over 500 uh, tenants right now. We only have a few that kind of skip out or don't work each year or that need to like exit a lease early. Most of them are fulfilling lease terms. So I'd say success rate has normally been pretty good, but we're also making sure like they have a business plan. It does cover the rent. We manage our TI up front, and the brokerage side does help us vet to make sure that, hey, this is a real, they can actually do this.
Got it. And The experience you've had sounds fairly positive. I'm curious on your underwriting, uh, of a tenant. Uh, is that something? Was there a learning curve on your end, or was that something kind of like you were able to take the experience information you had from other asset classes and just kind of, you know, say, hey, here's space, here's the tenant,
Yeah.
looks like a good fit, or
Yeah.
was there?
I mean, definitely a learning curve, but like me personally, like I'm fairly impatient. So when I'm working with a tenant, we said like we want to try and get that in faster and do that TI work faster. So that's kind of precluded from like big, lengthy build outs and really, really long term leases. So I think that's protected some of my investments on the near term. You know, 10-year leases sound great, and they can be great, but I prefer like how fast our underwriting models. How fast can we get to cash flow positive? So
Got
if
it.
we leave some longer term value out there, it's like, okay, but we got to cash flow positive faster. That's really a big push in our investment thesis.
Yeah, never undervalue the cash flow aspect of an investment. That's important.
Yeah, you got to if you have positive cash flow, you have a lot of options.
Yeah, yeah, no, absolutely. So speaking of strategy thesis, can you expand on what your investment thesis is specific to the retail?
Yeah, well, I mean, right now, retail we kind of see various opportunities in the retail side, and it's a lot of really mostly single story retail. So we've done stuff where we're taking single story office and we can convert it into bays where we can have businesses in it. Uh, we've been trying to buy some of these like Walgreens or CVS type box shops that have closed and carve those up as well into smaller suites. So a lot of the thesis is how do we take an asset that's in a good location, it's just being used wrong, and the rebuild cost if you were going to do something there is just too high. So therefore, we feel like we have an attractive rent price point because you can't really build something like this. Where we're typically buying it, you can't really rebuild this asset in the area because everything else has been built up around it. So then, therefore, we have pretty solid uh, demand for our supply. So we're really looking at it on the demand side, make sure like we can get in at a reasonable basis and we know we're going to have strong demand. And that ultimately just ends up in having positive cash flow for a longer term. And you can think about that as any kind of like you see these stories where someone's owned a building for like 40 or 50 years and it's in an excellent part of town and their basis is zero and it's always just rented and they're doing great there. You know, we're trying to do that, but just on the early stages of it. How do we get something that's good? We know we can rent.
Got it. Is there any particular design features you found that are you know, ones you look for, or perhaps ones you go, stay away from that?
Yeah.
Uh,
You know, we just look at different layouts of how a building is situated, and it makes it either easy or impossible to do what we do. A lot of that is if you're making a smaller suite and you need to have plumbing and water and utilities, and you need to have a firewall. It's like if you've got a funky shaped building, it just makes all of those things more expensive. So while having really really cool architecture is appealing and can be great, having a simple rectangle helps a lot when we're trying to do what we do with our space is give someone a rectangle that's usable. You kind of get all these funky shapes, and then it makes putting in firewalls harder. It makes running the utilities, especially if you're cutting concrete, like all all funky. So we try and avoid those. Not you know, we've got one deal that's like it's three rectangles, but then like, hey, tilt them at a 30-degree angle and then stagger them. It's like, what is going on here? The deal works. It's a good deal. But man, if it could have just been straight, that would have been a lot
yeah,
easier.
yeah,
So we look at that kind of stuff to really like, how is that going to impact our TI and really our time to deliver and our cost to get something turned into a white box that someone can use?
right. From a as a landlord, kind of common area curb appeal. Do you have any kind of key indicators you look for, or is there any kind of a on the
Yeah, that
value add approach? What,
I kind of stole my experience there on the multifamily side. When I was mostly buying apartments, I was always trying to see like how can I have the least amount of common area as possible. So you think about apartments like I don't want interior hallways, I don't want exterior hallways. How can I have, some of the most efficient deals were just townhome deals that had a direct entrance to that person's, you know, townhome, so less common area to maintain. I take that same approach on the commercial side of it, and it's like, how can we have the common area space and essentially like the parking and bushes and shrubs around it as efficient as possible, so you don't need endless maintenance to pick the stuff up. And that goes down to just different types of shrubbery that's in place, like what kind of trees you have in place. So they drop in, you have trees that are dropping stuff all the time that's got to be cleaned up. It's like trying to avoid that stuff. And we go in and we'll cut down or change out trees specifically because it's easier to operate once you have the thing. And that all those little tiny things just add to your future cash flow and maintenance and quality of the asset you have.
Oh yeah, and then get all that debris on your roof and plug your
Yeah,
drains, and I mean, on and on
it's
and
just
on.
little frustrations that all add up.
Yep, yep, yep. I get it. Um, so investment strategy, we've talked about, acquiring these and kind of leasing. Uh, are you guys buy and hold, or are you doing a value add sell? What's your primary mode of operation?
Yeah, most of the time, I look at an opportunity, and I'm in the mindset of if you buy this thing, you've got to have a game plan to be able to hold it because you don't know what the real estate market's going to be in 3, 5. So whenever your horizon is, you've got to be in a position that you can hold a deal. So we always look at it from that standpoint where we're saying, plan that we got to hold it. So you have to have sufficient reserves to do that, and you got to be able to get to cash flow positive. So we look at that. Ultimately, if in a horizon point, uh, anytime we have a loan maturing, we're always looking at, is it an opportunity to sell this and what's the market saying that value is worth? But we have a lot of flexibility if we're cash flow positive. So there, we don't really plan to exit something when we buy. We're planning that, hey, we're in this for the long haul and we're going to get to cash flow positive and we're going to hold it and keep making distributions. As we hit bumps in the road on that, I mean, we there's bumps all over the place. So that's when we then look to exit. Either cash flow is worth a lot, it could be sold at a great multiple, or hey, this is a deal that's just not hitting the targets we want to see, and then we'll look to exit that.
Your the who's investing with you? You mentioned we, and then distributions led me to believe perhaps some syndications, or how are you?
Yeah,
How
we
are you?
we are a syndication group, so we have
Okay.
a pool of LPs that join us on each deal. We are not a fund, so I don't. I normally talk about we as in me and my investors are making the decision of what to do. But yeah, we're not a fund, so every deal is one off. And if people like the deal, then they can join on that deal. If they don't like the deal, they can wait till the next one. And it's a little bit different because I am doing so many different types of assets that some basically people can limited partners can kind of pick their own little portfolio that they've put together. So right now, you know, everything from debt side issuances to retail to small commercial, some medical. That's a lot of the stuff we're buying right now. So investors can kind of pick and choose what they want to use.
Got it. And you mentioned the hold time. Your ideal is kind of forever on your. If you're doing syndications and that, is that the way it's presented on the for the investors, or is there like a horizon where you're going to refi
Yeah.
or opportunity to
Yeah. We
exit?
we always put in a horizon. I mean, we have our initial like what's our 0 to stabilization time frame. And once we hit that stabilization time frame, then we're looking at when's the next renewal time on a loan that we have. Our going in loans right now are typically about 5 years. We on the commercial side, we haven't done much like 7 or 10 year opportunities. So we're typically doing 5 years and then saying, okay, well, as we get to year 4, we're going to look at, is this a deal we want to hold or do we want to sell this deal? And we're typically just doing webinars with our investors and coming through. We present our analysis of what the market looks like and what's out there. And then if we want to take them out, we'll take them out. So we've done about 140 or so deals over the years, and our average hold is right around 5 years in general on that. But
Okay.
some stuff I've held 12, 13 years, and it's cash flow positive and, you know, good return. So we just hold them and keep going.
So in that, I wonder if you could just speak to it briefly here. The if you've got investors and you presented a 5-year hold and you get to that year 4 and you're going, this looks like a good one. Is that an opportunity for your group then to buy out the investors and hold for a longer term? Is that what I'm hearing?
Yeah, because we'll do essentially at that point we have to renew the loan. We'll
Yep.
say, hey, we're going to go get a new loan. Does anyone want out at this time, or does everyone want to stay? And we don't, we don't have huge pools in any of our deals, so it's a few people, and over the course of time, we've only had a few people that had different, like, hey, I want out of this one. It's like, okay, but for the most part, we come to a collective agreement, and we'll refinance that one, and it's like, okay, hey, we got another 5-year runway. We're going to look to perform on this deal, and then we'll have that conversation again. The longest one, we're on our third, loan renewal, and everyone stayed in it the whole time, and it's been a good deal.
No, that's great.
Yeah.
On the values from acquisition to lease up and exit, can you speak to any kind of your experience on some of these that you've gone full cycle on? How
Yeah, I
the
mean,
values?
there's a lot of value in the structure of how the deal is put together, right? So in my experience, when I see, like, hey, we have actual formal leases that are all well documented, that have the right terms and conditions put in them. It's not like a mom and pop lease. It's an actual lease that adds a lot of value to the deal because people know exactly what they're getting. And then as long as we have the thing that's clean, there's no easement issues. You got to kind of clean up that structure and make sure it works. Uh, and the, and then they all vary widely on like a price per square foot value, right? So, but our typical IRRs are over 20% when we have an exit on those.
No, it makes everybody happy if you're positive at the end there, and 20%. That's yeah. I can see everybody be happy and sign up
Yeah.
again.
But they've got
That's good.
to be cleaned up, and you've got to
Yeah.
get the right information in there so that it is you're improving the ability to have a transaction.
Right. Right. So to that, is that one of the driving mindset things where when you're selecting tenants, and is it constantly with a view on the exit, just to make sure you're maximizing your value?
Yeah, I would say that maximizing value comes. We look at that. I mean, one, yes, you got to buy it right. You got to be in a good. You have to, how to make good decisions on buying an asset, but the operations is key. That's where you can create or lose a ton of value in how you operate a deal. So we buy and operate all of our own assets. We don't really do any third party management uh, for other folks right now. So we're always looking at, hey, we're going to operate this thing. How can we operate it as efficiently as we can? And what can we do to make sure we're always improving how the thing operates? That ultimately just leads to improved cash flow and improved value. So everything comes from an operational mindset of how we execute a deal. And our team, we can't just go buy some random thing that we can't operate. We want to operate it so that we will only buy stuff that we know we can operate.
Got it. Um, from a management standpoint, uh, how intense is the management? If you got a full building, you've got quality tenants. Is it a daily, weekly, monthly activity at the property where your staff is having to go out and visit the property?
Yeah, for every tenant, I mean, every month we're making sure we go out and we talk to those tenants, whether we need to or not. Our team's going out, making sure we introduce ourselves to them. They know who we are. We're present and on the property. I think that's critical. So we're not doing a mailbox money kind of thing where we don't even go see this stuff. Like, no, we're there every month looking at what's happening and talking to our tenants. On the standpoint of like, how do they operate? A lot of times what we're working through too is ensuring that everyone there has a business license. Business licenses are done completely different, like county and city by city. Sometimes the real estate owner have to have that license. Sometimes the tenant has to have that license, and then that trickles into like, how are we doing our insurance? What is their insurance? So there's a lot of the compliance components of that as you're working with a business, and that's a lot of the time what we spend uh, our interactions in energy on when we're at a property is that. For the most part, they're taking care of the inside of their space, and we're maintaining the outside. So we maintain the parking lots and the grass and the roof and that kind of stuff. And we have that all on a pretty good schedule. We know when we show up day one, it's like, okay, here's the landscape schedule, here's the roof inspection schedule, here's the cleaning schedule. That stuff, we're we're pretty structured on how we get all that stuff done. But the relationship and knowing the tenant is where you got to put in some time.
Got it. And as far as that goes, do you have like an internal, some sort of an information management, client management system that you've got all this built out as far as what, the calendar of what needs to happen when,
Yeah.
or is that, yeah,
Yeah. Essentially, I mean, we've got our deal template and then an operations template. We use a platform called Asana, which was built out by one of the Facebook founders, pretty sure. And it's basically like task management. So we launch a new deal, and we launch a project, and it has literally all of our years of experience and things we have to check and things we have to look for, and things we know that can go right and wrong. We have all that built out in our deal templates. So then we launch deal 146, launch our template, and then it says, okay, here's really the marching orders for all the divisions within the business from the compliance standpoint, CapEx, inspections, lending, reporting, all that stuff is built out. And every time we learn something new, we sit down every month and just add to that checklist of, hey, what do we learn this month? There's always something. They were like, oh, this is a new curveball. Never saw that one before. That's what keeps it exciting or interesting.
yeah,
So there's always some other way to get kicked. It's like,
yeah,
oh, I got kicked again
exactly.
this month, but let's write it down.
Well, and the longer the list, kind of evidence of the more experience, and also trying to prevent that lesson from being learned multiple times. I'm a big fan of that.
Yes.
That's good.
Yeah.
And so you guys manage them internally. Do you rely on vendors for like the landscape and all that stuff beyond the actual management?
Correct. Yeah.
Okay.
Vendor relationships are critical to get a lot of the stuff done. Um, so that's a big part of how we operate. We do, we're big goal oriented, and lots of people talk about, hey, everyone's goal oriented and everyone wants to try and succeed, but we do a big goal day every quarter, at the end of the quarter. It just goes through everyone's really personal and professional goals of what they've accomplished for the quarter. And we invite our vendors to that as well. So they're involved. We want to see them do well. We want to see them have financial success and expand, because then that just enables them to help us and perform well too.
That's a
So
great idea, having them.
mutually beneficial
Yeah, they're
if we're both
invested.
successful.
Yeah, I mean, but just to get
Yeah.
that buy-in and investment into you and the way
Yeah.
you're operating, they recognize they're a critical part of the team. That's a good idea.
Yeah. And I mean, we've got some 10-year plus vendor relationships that have, they've been great for us. We couldn't do it without them.
Let me ask you on the we've talked a little bit about retenanting and that kind of stuff, but cap rates for some of the stuff that when you're acquiring it, can you give any kind of a range of what you've seen as far as the opportunity, and then where things are trading once
Yeah.
you've got them all leased up? And
Well, one way we're looking at stuff is if we can buy something that has a little bit of vacancy, but then we're buying it like even a 7 or 8% in place cap rate, like I like that. And then there's a little bit we can add to it, and we can get to a 9-10 cap rate where we hold it and have cash flow. So those opportunities we're looking for. We're not buying like fully stable 5 cap
right,
opportunities, and our cap rate will go down if we look at an exit, depending on who the tenants are there, right? So if we move in a couple medical users, we'll get a lower cap rate. But
yeah. Well, and the one thing I've come to recognize with some of the commercial properties is the value that's attached to a longer term lease. So if you've just renewed all the leases and they're A plus top drawer tenants, at least the way it's been explained to me, that's something where the new buyer has an opportunity to bank on income for, at least the near future.
Yes.
There's a, but I could see it being the opposite, like you're saying, if you recognize the opportunity with a bunch of vacancies because you've got some ideas for some good tenants, that could be a positive there too.
Yeah. We buy a lot of Dollar Generals. They're a good operator. I mean, they've, up and down news right now out on their overall performance and store, how stores are performing, but they've still got a lot of great performing locations. But a business plan there too is buying shorter term leases and extending them to longer term leases, and you have locked in cash flow for a longer time frame. The risk though is, leases done in, call it 2018 to 2020 had typically like maybe 1% escalations on them. And now we see now 2024, 2025, we can get like 3.5%, 4% escalation. So that's a big difference if you lock in 10%, 10 years at 1.5%
1%, yeah, yeah,
versus 10 to 4%. That's a big difference.
yeah. No, that's big. Um, Tell me a little bit about what's the lending environment look like for these retail properties you're buying?
Uh, Overall, I mean, I don't think it was ever really as aggressive as some of the multifamily stuff that was out there in the lending environment. So, we're typically like 55, 60% leverage. And right now we're seeing 6.5%, maybe 7% on the debt front. So it's not like it's, hey, run out there and borrow as much as you possibly can right now. That's certainly not the case, but it's also
Yeah,
not terrible. I
yeah,
mean, it could
it's
be a
work.
lot worse in yes, the zero interest rate stuff of, the early 2020s, it's like, okay, but you look at the reality of time, I would say, and that's kind of where it lies. And we're able to get deals done at that price point. Um,
What kind of amortization schedule are you getting on that? Is it
it's like
20,
25, but we're,
25?
we're always, I'm a fan of paying down debt. I like, we can
Yeah.
get longer term and even lower AM. So we're paying off more principal. I'm a fan of that. I like that strategy. It's not always, again, it's not always the sexiest avenue to go because you can do these stuff and do that
Yeah.
forever, but different, different appetite on how you want to structure a deal.
Well, and also, if you get to the end of that and the values haven't gone up like you were counting on, or you know, I'm a big fan of debt reduction. That's
Yeah.
for the
I
long
look at a
term.
report every month that just shows how much principal have we paid off this month across the portfolio as a whole.
Yeah.
I look at that, I get excited. I'm like, how do we just incrementally get that up a little bit every month?
Yeah.
I'm happy with
I,
that.
yeah, it was kind of one of my appeals when I first got into real estate was recognizing that, the tenant was paying off my mortgage. I thought, wow, that's awesome.
Yeah.
And if you can make that happen faster, that just means that much more for you when the mortgage is paid off. So that's
Yep.
good. Hey, David, if we could, I'd like to shift gears here for a second. As I mentioned to you before we started, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If we cannot avoid the risk, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can take a look at their own situation. It could be your clients, investors, your tenants, construction costs, the Fed, whatever it is
Yeah.
that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, David Codrea, what is the biggest risk?
For me, what I see as the biggest risk that impacts my business the most is time. So it looks at it, there's a huge benefit to time, but there's also a huge risk if you are not able to get the ball moving on things. So extended vacancy or even just time to make a decision. If it takes too long for your organization to get things through, to get approval for something or make a decision on what you're going to do with this tenant or that tenant, I think that can lead to a lot of risk. Because one, you've got an organization that doesn't really know, like, hey, how are we making a decision? When are we going to make the decision? And no one knows. You have, opportunities that can be missed because of inability to move. And I think if you look at business as a whole, a lot of times really, really big companies, you look at like the 10 biggest companies that are out there, it used to be that big companies would get slower. And now the more the shift is, some of these big organizations are just getting faster and faster and faster. If you look at Amazon, they've just been pushing to go faster. It used to be you get something delivered in a couple days, and then it became next day. And now it's like, hey, can we do this same day? Like, they're getting faster. I think they're realizing that time is the biggest risk that they have for them to lose a customer. In my business, I'm not Amazon, but if we don't get back to people, we're going to lose them. That mentality is shifting through to everyone. Everyone wants everything right now. So if you don't have a way to do things faster and avoid that loss of time, I think that's the biggest risk that's out there, and probably for any business.
It's funny you say that. I've had this conversation numerous times, and I feel like it's part of just getting older and recognizing, kind of the change in the way the next generation responds or whatever. But it's like, there was a time when, man, when the phone rang, it was like, pick it up, and now I feel like everybody's on like, let it go to voicemail. And but there is that sense of like the opportunity, sense of urgency that I feel like is important to be successful.
Yep.
That's good.
I'm also impatient, so I don't know if that's just me too.
Yeah.
It's like, that's my own thing.
Yeah,
other people that are really patient, it's like, man, they say patience is a virtue. It's like, but they're able to like control it. I'm like losing it over there. I'm like, if stuff's not happening fast.
Yeah. Well, no doubt time is money, especially with real estate, and a long vacancy doesn't pay. So
No,
fill it up. Hey, David, where can the listeners go if they'd like to learn more or connect with you?
Yeah, all my information on LinkedIn. So my company website is up there, and I got my email and phone numbers that are there on LinkedIn.
Got it. Well, David Codrea, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, Darren, great to be here. Thanks.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.